John asks, is the best strategy to monitor often and closely return on each investment option and change often to the investment option with the highest return? This is a really good question, John, because I had someone call in about this recently, that they got a sense that the market was going to go through some volatility, and they called up Christian Super and said, can I change my investment option? And they said, yes, go online and you can go and change it yourself. It's the quickest option. But how most superannuation funds function, unless you've got your own self-managed super fund, is that there's a delay between the time that you say, yes, I want to change, and it actually happening. So it's once a week for Christian Super. So if you, I can't remember which day it is, but if you put your transaction, say for example, I don't know exactly what day it is, but if you put it through on Tuesday, it might not happen until the next Monday. So you've got this whole time lag that makes that strategy, particularly if you're wanting to time the market in shorter term moves, it's a really difficult thing to do. And if you look at the long-term outcomes of those kind of decisions, it usually has a negative impact. And there's lots of research that says that if you change more than once a year, it generally has a negative impact on your long-term returns. There was actually a study on a particular fund in the US that returned over a 10-year period, it returned 12%. So it returned a really good return, 12% return over a long period of time, 10 years. And they went through and researched what the individual investor returned on their money, and it was 2%. And it was this whole approach that people bought into the market at the peaks. The fund was going well, it's had a really good year, and so everyone puts all their money into the market. They're buying at a high point. And then the next year, inevitably, the investment managers have got a heap of cash, and then they need to invest it. And inevitably, the following year is a negative one. And then what happens is that people at that low point feel uncomfortable. It's a bad investment. Let's get out of it. And so they pull their money out. They've effectively done the thing that we encourage people to avoid all the time. They're buying at the high point and selling at the low point. And if you're a contrarian, you might be able to manage this process effectively. But as we talk through on that Brinson Benbow study, where we talked about where asset or returns come from, it's the asset class that provides the majority of the return, not getting in and out of the market. It's fraught with risk, and it's even more difficult because of the time lag with changing your investment options. So I wouldn't necessarily encourage it. What I do encourage is people to do it slowly over time. So if you're wanting to move, like I talked about before, if you've got $500,000 and you're really wanting to access that sum of the money, or $100,000 of that money in 2 years' time, start to draw down $5,000 a month for the next little while, and that will reduce the risk of moving in and out of the market in large movements.